Welcome to today's crop insurance webinar presented by Cornell Cooperative Extension, Lake Ontario Fruit Program. My name is Mark Wiltberger. I am Business Management Education Specialist for the Lake Ontario Fruit Program, Cornell Cooperative Extension. Today's crop insurance webinar is titled Types of Crop Insurance Available for Apple Growers. In today's presentation, I will address what is crop insurance? Who are the providers of crop insurance? How does crop insurance work? How does APH insurance for apples work? What are other insurance options for apples? And how much will insurance cost you? What is crop insurance? Crop insurance is a policy that the farmer purchases yearly to protect their crop yield or revenue from production risk. Note that crop insurance may protect either yield or revenue, and it provides protection against production risk as opposed to protection against other types of risk, such as market risk. Who are the providers of crop insurance? There are two fundamentally different providers of crop insurance: private insurance companies and the US government. Just like other kinds of private insurance, for example, a home, auto, or business policy, a private insurance company assesses risk and provides a policy that addresses specific risks. Private companies are looking to make a profit, and in exchange, they provide the service of lowering risks for farms. On the other hand, the US government provides crop insurance according to US law. The purpose is to create stability and lower risk for the agricultural sector of the economy. The government is not looking to make a profit. In fact, it must follow regulatory guidelines for setting premiums and indemnities. Federal crop insurance is provided by the U.S. Department of Agriculture Risk Management Agency, or RMA. Although the insurance is provided by the federal government, the government uses private insurers to implement the crop insurance policies. Private insurers get paid a fee to implement the policies. So even though you are working with your private insurer to set up a policy or file a claim, it is federal crop insurance. For crops that are not covered under federal crop insurance as set forth by the law, the U.S. government provides disaster assistance through the Farm Service Agency, abbreviated FSA. This program is called the Non-Insured Crop Disaster Assistance Program, abbreviated NAP. NAP is in place of crop insurance and works differently than crop insurance. Today, we are focusing on federal crop insurance provided by the Risk Management Agency. What are the types of crop insurance provided by these two different sources? Private insurers tend to provide a kind of insurance called single peril. It's also known as named peril. Instead of insuring against any type of peril that could impact a farmer's production, it provides insurance against specific types of peril only. Crop hail is a very common type of insurance from private insurers. Hail damage is very common for many types of crops, so private insurers create policies that provide insurance against it. Federal crop insurance from the USDA RMA is multi-peril insurance. It will insure against multiple types of peril. An example with apples is hail damage and frost damage. If flowers were damaged by a spring freeze event, federal crop insurance will protect against this risk. If there is a hail event just before harvest, it will protect against this as well. There are conditions attached to this, which is laid out in the policy. Part of the cost of the insurance for the farmer is subsidized by the federal government. So that's another difference. And as mentioned before, federal crop insurance is purchased via private insurers. How does crop insurance work? Now I am going to go through some of the basics of crop insurance with some definitions of insurance terms and how they apply in the context of federal crop insurance. Definition: premium. The premium is the amount of money you pay for risk protection. The person who buys an insurance policy pays a premium in order to obtain coverage. Most of us are familiar with this concept. We pay premiums on auto insurance, health insurance, and property insurance. For federal crop insurance, part of the premium is paid for by the federal government. This is why, depending on your circumstances, federal crop insurance may be a good deal for a farmer. You get more protection from risk at a lower cost to you. Definition: indemnity. Indemnity is the compensation or money you receive for qualifying losses paid under an insurance policy. It's also defined as the portion of the insured loss in dollars paid by the policyholder. Indemnity just means the amount of money you will get when you file a claim for a loss. The indemnity is paid by the policyholder, which in the case of federal crop insurance is the federal government. How the indemnity is calculated and the conditions under which it is paid is the key thing, which we will get into in a moment. Definition: guarantee. Also called yield guarantee or insurance guarantee, this is a promise of payment. In this context, it means the amount of money you will be paid in the event of a loss, according to the terms of your crop insurance contract. The guarantee is a promise of payment. It is the amount of payment you will be paid if you have a loss. It is according to the terms of your crop insurance contract. It's also known as a yield guarantee or an insurance guarantee. Understanding how this is calculated is key to understanding crop insurance. Definition: deductible. An amount representing the first part of a claim which an insured has to bear as stated in the policy. The deductible is usually expressed as a percentage of the sum insured, but may equally be a monetary amount. Most of us are familiar with a deductible. We have deductibles for vehicle insurance and for health insurance. It is a part of the claim which the farmer has to bear. For the type of crop insurance we will talk about for apples, the portion of the claim the farmer has to bear will not be called a deductible, but in effect, there is a deductible for the farmer. How much is the indemnity? The indemnity compensates for losses that exceed the deductible up to the level of the insurance guarantee. This is a calculation stated in words. I find it a little easier to write it as a formula, which is written below. Indemnity equals losses minus deductible. With the additional condition, indemnity will not be greater than the insurance guarantee. So the amount you will get paid, the indemnity, will not equal your calculated losses. The deductible will be subtracted from the losses. And if that calculated amount is greater than your insurance guarantee, the amount you will get paid will be the lesser value. The insurance guarantee would be the maximum amount you would get paid. For apple crop insurance, the word deductible won't be used, but the concept of a deductible will still be there. Here are the insurance options of crop insurance RMA offers for different fruits. So we can see how apple crop insurance fits in. Catastrophic insurance, abbreviated CAT or CAT, is a yield protection policy for catastrophic losses. Actual production history insurance, abbreviated APH, insures producers against yield losses due to natural causes such as drought, excessive moisture, hail, wind, frost, insects, and disease. Actual revenue history insurance, abbreviated ARH, has many parallels to the APH plan of insurance, with the primary difference being that instead of insuring historical yields, the plan insures historical revenues. Whole farm revenue protection insurance, abbreviated WFRP, provides a risk management safety net for all commodities on the farm under one insurance policy and is available in all counties nationwide. The supplemental coverage option, abbreviated SCO, is a crop insurance option that provides additional coverage for a portion of your underlying crop insurance policy deductible. And non-insured crop disaster assistance program, abbreviated NAP, is not crop insurance, as I mentioned before. It is disaster assistance. Insurance products for fruits in Lake Ontario counties. This chart indicates which types of insurance products are available for which kinds of fruit crops in the Lake Ontario counties. If you are in another region or county, you need to check the RMA site to see if that product is available for that crop in your county. The main takeaway from this chart is that for apples, the main product type is an APH, actual production history. The insurance policy is based on the historical yield of apples produced. You can see that tart cherries is an ARH, actual revenue history product. It is based on the historical revenue from cherries, not the yield. Peaches and grapes are APH, like apples are. Starting in crop year 2020, pears will be covered as APH for Niagara County only. It will also be covered in Ulster County in the Hudson Valley. The other fruits are covered by NAP, Non-Insured Crop Disaster Assistance Program. They are not covered by crop insurance. The SCO option is available for apples, grapes, and peaches, the supplemental coverage option. All farms in all counties may purchase whole farm revenue protection as an alternative to these other products. Crop insurance for apples, actual production history. The most commonly used product type for apples is APH, actual production history. Actual production history policies insure producers against yield losses due to natural causes, such as drought, excessive moisture, hail, wind, frost, insects, and disease. Crop insurance for apples, the RMA fact sheet. The best guide for understanding crop insurance for apples is the RMA fact sheet. I recommend downloading the regional office fact sheet for apples and the national fact sheet for apples. Those are available at these links at rma.usda.gov. By going through each section of the regional fact sheet, which you see the first page of here on the right, you can figure out all of the elements of apple crop insurance you need to understand in order to decide to implement it for yourself. I will be using sections of the regional fact sheet as a guide for the next part of this presentation. The regional fact sheet for New York comes from the North Carolina RMA office. This contains specific facts for states in the eastern United States, including New York State. Finding a crop insurance agent. In order to purchase federal crop insurance, you'll need to find and work with an RMA agent. An RMA agent is a private insurance agent who will provide the crop insurance. The RMA agent will tell you the type of insurance product for which you are eligible. They will also assist you in setting up insurance units. The RMA agent locator is located at this page on the RMA site. You can put in your location and find agents that are close to you who provide federal crop insurance. Although I will discuss using RMA calculators to estimate premiums in a few minutes, it is only by working with an RMA agent that you will know the actual premiums you will pay. They will also be able to tell you the amount of your yield guarantee and explain other details of your specific policy. Although we are going to learn about these things today, in reality, the details of your policy will be set up by your insurance agent. If you are thinking of getting federal crop insurance or changing the options on your federal crop insurance, you should contact an insurance agent as early in the process as possible, as some of the steps, such as setting up your insurance units or calculating historical yields, take time. Let's go back to one of the definitions. Deductible. An amount representing the first part of a claim which an insured has to bear as stated in the policy. The deductible is usually expressed as a percentage of the sum insured, but may equally be a monetary amount. With APH and ARH, the language of a deductible is not used. Instead, the concept of coverage level is used. The percentage not covered is essentially your deductible. For example, if you have 75% coverage, then the 25% not covered is essentially a deductible. Apple APH, coverage level. Apple APH coverage levels are at 50%, 55%, 60%, 65%, 70%, and 75%. The higher the number, the more coverage you have. Note that the highest number is 75%. That means at the very least, you will have to bear the first 25% of a loss. In other words, it is similar to having a 25% deductible. If you choose a lower coverage than 75%, your effective deductible is higher. APH, price elections. Price election is an established price used to calculate your premium and indemnity. For apples, the price selection is essentially how much you are going to be paid in a loss for a bushel of apples. The term election refers to choosing among the different options, such as fresh versus processed, or choosing a varietal group. Contract pricing options are available for certified organic crops grown under guaranteed contracts. If you are growing organic apples, it is possible to work under contract pricing options. For price selections, see your state's actuarial documents at the Actuarial Information Browser at this link on the rma.usda.gov website. When you go to this link, you enter into the form your crop, your state, your county, and other information, and the browser will tell you which price selections are available to you. Apple APH, insurance units. The insurance units are the building blocks with which your policy is built. They are essentially acreages of crop. Premiums, losses, and indemnities are calculated for each unit. A basic unit. A basic insurance unit includes all your insurable apple acreage in the county in which you have 100% share or which is owned by one person and operated by another person on shares. The basic insurance unit is all of the apple acreage owned by you. Optional units. Optional units may be established if you can provide separate records for each unit and the acreage is not insured under a catastrophic or CAT policy. Optional units may be established by non-contiguous land, Farm Service Agency farm serial numbers, irrigated or non-irrigated practice, or by type, fresh, processing, varietal group A, varietal group B, or varietal group C. Note that if you choose optional units, you must be able to provide separate records for each unit. When deciding what kind of unit options to choose, this last item here by type makes a big difference. How your units will break out by type, fresh or processing, or varietal group A, B, or C, will affect your premiums and indemnities and the probability that you will qualify for a claim. Apple APH, insurance units, record keeping. You will need to have a system for recording your production history for the type of insurance unit option you choose. Types of insurance unit options over which you have some choice: basic units, fresh versus processing units option, and for fresh, breaking it out into the varietal group units option. Are you going to get just basic units, fresh and processing units, or are you going to break your fresh units into varietal groups A, B, and C? Changing from fresh / processing insurance units to varietal group insurance units may entail significant increase or change in record keeping practices, but it may increase the probability of being able to claim an indemnity under certain circumstances. Apple insurance units. You will need to sit down with your insurance agent to demarcate your insurance units. Apple APH, the varietal group option. For the 2020 crop year, varietal groups are defined as varietal group A, Honeycrisp, Pizzazz, and Sweet Tango Minasca. Varietal group B, Cortland, Empire, Fuji, Gala, Jonagold, McCown, McIntosh, Ozark Gold, Paula Red, Crips Pink, also known as Pink Lady, Red Rome, Ruby Frost, Snapdragon, and Zestar. And varietal group C are all other apple varieties not specified in varietal group A or varietal group B. Varieties may be added, removed, or moved by the RMA from one year to the next. Apple APH, price selections. Price selections are what you will get paid in an insurance claim for a bushel of apples. If you elect to create fresh and processing insurance units, you will be paid in crop year 2020 $12.50 for a bushel of fresh apples, and $3.45 for a bushel of processing apples. If you elect to create varietal group insurance units, you will be paid $37 per bushel of varietal group A, $15 per bushel of varietal group B, and $11 per bushel of varietal group C. These prices are adjusted by RMA from year to year based on price history. Loss example, APH for apples. Let's go through the example calculation on the RMA fact sheet. Assume fresh apples with an approved yield of 600 bushels per acre, 65% coverage level, non-irrigated, 100% share, and a 1 acre unit. Starting at the top, the approved yield per acre. This is the amount based on your production history that block of apples produces. You determine this by working with your insurance agent using your production records. In this case, it is 600 bushels per acre. Coverage level. This is the coverage level you chose. In this case, the coverage level is 65%, represented by the number 0.65. The maximum coverage level you can choose for apples is 75%, and the minimum is 50%. Acre guarantee. The acre guarantee is the yield guarantee per acre. This is the maximum amount of yield you are guaranteed for loss. The acre guarantee is the approved yield per acre times the coverage level. In this case, it is 600 bushels per acre times the 65% coverage level, equaling 390 bushels per acre. So even though your block can produce 600 bushels per acre on average, you will only get compensated for a maximum of 390 bushels. This goes back to the definition earlier of how much is the indemnity. Remember, the second condition of the indemnity is that the indemnity will not be greater than the insurance guarantee. Moving on to the next item here, production to count. This is a measurement of the amount of crop harvested or the unharvested amount appraised by the adjuster in the field. It is the amount of, quote, good fruit that is there in the field. For example, if the adjuster looks at your hail damage and says, you have 40% damage, that means your production to count will be 60% of the approved yield. According to the adjuster, you should be able to harvest 60% of the fruit to grade. The insurance will not compensate you for good fruit, so the production to count is subtracted from the acre guarantee. It does not matter for the insurance whether the good fruit is harvested or left on the tree. Good fruit will not be compensated for in either event. Loss per acre, the next line. The loss per acre in this example is the amount of fruit that will be compensated. The loss per acre is your acre guarantee minus your production to count. In this case, the acre guarantee was 390 bushels. The production to count was only 100 bushels. In this example, that meant that there was over an 80% loss on 600 bushels because there was only 100 bushels of good fruit. So 100 bushels per acre is subtracted from 390 bushels per acre. The loss per acre that is covered by the insurance is 290 bushels. Now moving on to the next line. Price election. The price selection in this example is for fresh apples. This price selection pays $12.50 per bushel in crop year 2020. And the final line, indemnity per acre. The indemnity is the amount you get compensated per acre. The indemnity is the loss per acre times the price selection. In this example, it is a loss per acre of 290 bushels times a price selection of $12.50. So multiplied together, in this case, you would get paid an indemnity of $3,625 per acre. So that's talking about, we just went over how APH is calculated. I'm going to briefly mention several other kinds of insurance options that are available for apples. The first is CAT, or catastrophic. If you don't get apple crop insurance APH insurance, you should at least get catastrophic risk protection. It is an administrative fee of $300 for all of your apple production. In the event of a total catastrophe, you will at least get some amount of an indemnity. Catastrophic risk protection coverage is fixed at 50% of your average yield and 55% of the price selection. The cost for CAT coverage is an administrative fee of $300. As you can see from the 50% of average yield and 55% of price selection, it will only pay a fraction of your total loss, but it is some compensation. You must choose between catastrophic coverage and other types of coverage. You cannot have both types. Another option that's available for apples, the supplemental coverage option, SCO. Supplemental coverage option is a newer product. SCO is available for apples in some counties. If elected, SCO provides additional coverage for a portion of your underlying crop insurance policy deductible. You would get this kind of insurance in addition to the APH insurance. It's not standalone. You don't get it instead. It's an add-on to APH insurance. It lets you bump your coverage up from 75% to 85%. In effect, you would have a lower deductible. The federal government would start paying losses after you bore the cost of the first 15%. It is calculated differently than APH insurance. This link on the agriskmanagement.cornell.edu website, called Supplemental Coverage Option for Apples, explains SCO insurance in detail. There is also a crop insurance for apples SCO fact sheet from the RMA. It is at this link at the rma.usda.gov website. So we're going to talk about Apple APH Premium Estimator. Trying to figure out if federal crop insurance is a good deal for you or what level of option you should choose can't really be done without finding out how much it is going to cost you. There is a premium calculator on the RMA website that you can use to get an idea of your premiums. The website, the cost estimator is here on the RMA website. They have two calculators, a quick estimate and a detailed estimate. As I said before, you will need to sit down with your insurance agent to determine your actual premiums. Premiums may be significantly different when changing from fresh/processing insurance units to breaking out your fresh units into varietal group insurance units. You should work with your agent to understand the impact on your premiums of changing your unit option. I will go through the quick estimate now to show you how you can get an idea of what premiums are when choosing different options. There's a lot of information on the RMA calculator page, and it can be a little overwhelming. So I am just going to go through it step by step. This is a screenshot of what the quick estimate form looks like. This link is also on the cost estimator page linked in the previous slide. In fact, all of these links are available on the USDA website, but it can take some time to find them. So you may want to use this as a reference, this presentation as a reference also. So at this first page is a form that you enter information in about what type of insurance you want to estimate. You enter the criteria for the insurance unit you want to estimate in this quick criteria box here. For commodity, you select apples. The next line, commodity year, you select the crop year you want to estimate. In the case of this example, it is 2019. At the time that this webinar is being presented, the upcoming crop year that you might wish to estimate is crop year 2020. You would select that there. So next line, state, select your state, in this case, New York. In the next line, select your county. In this case, I've selected Orleans County. Then the next is the type of insurance. In this case, we want to estimate an insurance unit for the fresh insurance option. Other options that will pop up in this drop-down list are processing, varietal group A, varietal group B, and varietal group C. The next line, practice. Under practice, select the type of practice for the insurance unit. In this case, non-irrigated is selected. There are also options for irrigated and for organic, irrigated and non-irrigated. The next box, common criteria box, indicates that all units to be entered below are to be entered in units of bushels. Now you go down to the next box, individual coverage. And it's got APH 90, the type of insurance that you selected to get here. Your sub-county code, there may or may not be a sub-county code to select. In this case, there was not. Then the next line is your price election. The 100% item selected at the top is the current price election for each type of crop. In this case, $12.15 is the price election for a bushel of fresh apples. Typically, you would select the 100% full price election amount for your insurance unit. The next item, the next line is reported acreage. You enter the acreage of the insurance unit. In this case, it is 100 acres. In the next line, the approved yield, you enter the approved yield determined with your insurance agent using your production history. In this case, I have entered 800 bushels per acre. The next line, rate yield, is only used if the approved yield is not based on the production history. So in this case, the field can be left at 0. There is a little question mark information pop-up with a little bit more explanation of when that would be used. The last line, insured share percent, is the share percentage that the insured, which is you, own of the crop. In most cases, this is 100%. So this value may be left at 1.000. Now, this page goes on a little bit longer. Below this individual coverage box is a box for the supplemental coverage option endorsement. We are not looking at SCO coverage in this case, so we would pass over that and just leave it as it is. Below the SCO box is a button that says Get Estimates. So you would click on that button after filling this part out, and then the results are generated. So you click on that button, and then you get the results screen. And as you can see, it's got very tiny print and kind of spread out all over the screen here. This is the top part of the results screen. And the top of the results page just shows you what choices you put in on the previous page: apples, Orleans County, the commodity year, the type. They can be seen in this first box, the selected initial criteria box. They can be seen in the common criteria box, bushels per acre, and the next box, individual coverage. That's what you filled out at the bottom of the previous screen. And then the supplemental coverage, we didn't enter anything for that, but if we had, it would show up here. The results are further down on the page, and I have them in the next slide as sort of the bottom part of this page. So this is the bottom part of the APH Quick Estimate results page. Now, the key part of this results page is this show in grid. See that show in grid box here. By selecting one of these 5 options here, 1, 2, 3, 4, 5, the results for that option will be displayed at the bottom of the page here. So the 5 options are liability amount, total premium amount, producer premium amount, subsidy amount, and loss trigger point. And so go over these terms that they have for these different options you can choose to display. The liability amount, the terms being used are liability amount. This is the amount you're covered for. It's based on your coverage level that we talked about earlier. The total premium amount is the total premium that is paid. However, it's shared between you and the government. Producer premium amount is your premium share. That's your share of the total premium amount. The premium subsidy amount is the share of the premium paid for by the government. And the loss trigger point is the same as an acre guarantee or a yield guarantee. If the yield falls below the loss trigger point, a possible loss has occurred. And the loss is calculated the way I showed earlier in the presentation. So we'll show some of these options being displayed here. So if we select the first option, liability amount, then the liability amounts will be displayed down here. See this title, liability amount. In this case, for the APH coverage, if you chose to have 75% coverage, you would be covered for a maximum liability amount of $729,000. This would be for the yield of 600 bushels per acre. If you remember, we had an approved yield of 800 bushels per acre, and we chose the 75% option, so we were covered for 600 bushels of the 800 bushels. And so this is just 600 bushels per acre times the price selection of $12.15 per bushel. So for the 100 acres that we used in this example for the size of the insurance unit, this covered yield for all 100 acres is valued at $729,000. And as you can see here, if you elect a lower percent coverage, your liability decreases accordingly because you're being covered at a lower amount of bushels per acre. So the producer premium amount. So I've gone from liability amount option here. I've skipped over total premium amount. I've gone to the third option, producer premium amount, to display the producer premium amounts. The producer premium amount is the amount you, the farmer, would need to pay to get the coverage for the criteria you selected. So this is your share of the premium and how much you would have to write a check for. In this case, if you selected 75% coverage, then you would need to pay $31,461 to get that coverage for 100 acres. As you can see, as we move to the right here, the lower the coverage you choose, the lower the premium. If we clicked on this subsidy amount option, the page would show the share of the premium that the government would pay. And if we clicked on the total premium amount, it would show the combined amount paid by you and the government together. The lower the coverage you choose, the greater the share the government pays of the premium. You can see here that at 50% coverage, your share of the premium is quite a bit less at $7,846. It's quite a bit less than the premium for 75% coverage, which is $31,461. The premium for 75% coverage is about 4 times the amount of the premium for 50% coverage. However, with a lower percent coverage, it is a much higher threshold to trigger a loss, and the indemnity you would get paid with a claim is much less also, as we saw on the liability amount option here. So now I went over and selected the last option, the loss trigger point. Then we select this option and the loss trigger point is displayed below under the individual coverage box. Only when the yield from the crop falls below the loss trigger point will there be a possible loss. In this case, if you chose 75% coverage, then your yield would need to be below 600 bushels per acre to trigger a loss. 600 bushels per acre is 75% of the approved yield of 800 bushels per acre. If, in this case, the yield was less than 600 bushels per acre, then the loss would be calculated by the formula we went through earlier. The maximum that will be covered will be for the percent coverage that was chosen. In this case, the maximum that will be covered will be 75% of the approved yield of 800 bushels per acre, which is 600 bushels per acre. If the crop appraiser estimates the loss at less than 100%, or if some fruit can be harvested as the type of fruit that's insured, the amount of, quote, good fruit will be subtracted from this loss trigger point, which is also called the yield guarantee, to determine the actual loss. In the calculation earlier, this amount was denoted with the term, quote, production to count. important dates. As you can see, using the quick estimate is a way to get an idea how crop insurance for apples works and to see how choosing different options will affect your coverage and your premiums. However, to know what all of the costs to you will be and to set up crop insurance, you must work with your insurance agent. The sales closing date this year is November 20th. Talk to your insurance agent to find out what information you need to provide by that date to have insurance for the coming year. So the upcoming dates: sales closing date, November 20th. Production reporting date, January 15th, 2020. Acreage reporting date, January 15th, 2020. Premium billing date is August 20th, 2020. And the end of the insurance date is November 5th, 2020. Even if you choose not to change your insurance for next year, after talking to your insurance agent, you will have a better idea of what actions you may wish to take if you decide to set up insurance for the following year. Additional information about crop insurance is at the Cornell Crop Insurance and Risk Management Education Project Resources website at agriskmanagement.cornell.edu. This presentation was made in partnership with the USDA Risk Management Agency in order to deliver crop insurance education in New York State under the following award. My name is Mark Wilperger, and I'm Business Management Education Specialist for the Lake Ontario Fruit Program of Cornell Cooperative Extension. Thank you for your time.